welcome to BloombergQuint. A working group of the Reserve Bank of India has suggested the entry of corporates into the banking sector, albeit with safeguards, including requisite amendments to the Banking Regulation Act. But why now? Asked Dr. Raghuram Rajan and Acharya in a post on LinkedIn earlier this week. Dr. Raghuram Rajan is joining us today to help us understand his views a little bit better. Dr. Rajan, it's a pleasure to have you here. Thank you so much for your time, sir.
Thanks for having me.
Dr. Rajan, let me first start by asking you where your worry stems from. As you well know, and you put in your note as well, this is an idea that was on the table in 2013 when the final licenses were given out. Cooler heads or saner heads prevailed, and we didn't allow the entry into corporates into banking. Does it worry you that the idea is back on the table, or does it worry you more contextually, given where we are in the financial system in India and the economic reality?
Both. At the end of that licensing process, when we set out the terms for longer-term on-tap licensing, we had indicated from the RBI that perhaps it would be wise not to let full-fledged corporates, that is, industrial houses whose primary business was industry or non-finance activities, into banking. And we had left some room for houses that were primarily financial companies to enter banking. So it's not as if all industrial houses are prohibited. It's just those that are primarily outside of the financial business. And the idea was, just following practice in other countries, but also experience in other countries, as well as our own experience. The temptation for industrial houses to lend to themselves, what is called self-lending, is significant. And of course, this happens more in bad times when the industrial house is in trouble. And that's really a time when the bank should be exercising tremendous caution on who it's lending to and how much it's lending. And of course, if you're owned by a borrower, it's very hard to make that distinction. And previous episodes of allowing this in the US, this is called banking and commerce, but across countries where there's been banking and commerce, there's been pretty severe crises. Does not mean that there are no good industrial houses that will stay independent, but the conflicts of interest are significant. So that's one reason why this has been prohibited in many countries, also in India. The second reason is that it creates an undue concentration of economic power. People put their money in banks, they think it's safe. If you have a bank, if you own a bank and you need the money, well, it's very easy to get the money as an industrial house. You can grow significantly based on owning a bank. And that makes you enormously powerful economically and also to some extent politically. And this is one other reason why banking and commerce has been frowned upon in other countries. Let's keep the financial side separate from the industrial side. That allows for more competition on either side and eliminates the conflicts of interest. So for sound reasons, the RBI historically has not permitted it. There was a short episode, when the first banking licenses were given out, when in fact the rules had been changed. And based on the experience during that time, we decided there were plenty of good possibilities outside the industrial house sector for new banking licenses, and there was no need to let them in. And so we changed the rule back to what it was before.
Dr. Rajan, I'll divide the conversation into principles and practicality. On principles, like you alluded to, and the report also speaks of, that even in markets like the US, yes, there is debate about the separation of banking and commerce. But from your vantage point, have you seen that debate evolve to any point where that line would be breached? It seems that while the debate has continued, there doesn't seem to be any other alternative workable model out there to transition to where banking and commerce can intermingle.
Well, typically, they haven't been allowed. It hasn't been allowed in the United States. There are stray instances of, small entities owning a bank, sometimes at arm's length. But in general, you haven't had, the mega conglomerates which combine industrial houses along with strong banks. places like Japan, we had that. We had the zaibatsus, which were basically industrial combines around a house bank. And there was a belief that it was the strong zaibatsus which led Japan into World War II. The concentration of economic power also meant a concentration of political power. And it led to dictatorial tendencies that drove Japan into war. And in fact, post-World War, the US administration focused on breaking up the zaibatsus. Similarly, in Germany, the post-World War II US administration broke up the large combines in Germany, and arguably that helped German democracy post-World War II. So this is an old debate. Self-lending is part of the issue, and it's important in India, where the ability to regulate and supervise is still is a work in progress. But apart from the financial risks, financial stability issues, is the economic concentration issues. And in India, as we have some industrial houses gaining tremendous economic power, it's an issue which has to constantly be examined. And it's one reason why we had this rule on the table.
Okay, so simply saying that we will amend the Banking Regulation Act, simply saying that we will work on consolidated supervision, we will perhaps bring stronger arm's length principles or exposure norms, etc. Those are not adequate to address the the inherent challenges in such a model, you would say.
Well, I mean, you've seen the difficulty in India in determining connectedness. Who's connected to whom? We know, in the past of, entities supposedly bringing in equity into a venture, but in fact, that equity has been borrowed by somebody else within the group, except you don't know the flows within the group of how those flows take place. So when things are still quite murky, when we have only modest confidence in accounting, when we have, we are working on making sure supervision is stronger, that we have minute-by-minute evidence of where the money is flowing. When we don't have any of this really in place, simply laws will not make a difference. I mean, you can exhort to all you want and criminalize to all you want some of these transactions, but they still take place. And the reality is that until we have much greater confidence, and even then, what is the reason you need this, right? If you want more talent in banking from the private sector, you can always create more banks. But they can be opened by professionals, they can be opened by financial houses, they can be opened by industrial houses that are largely in finance, and there are a number of those. So there's plenty of opportunity you haven't exploited yet. So the question is, why do you need to give the license now? Who is there knocking on the door at this point who says, I want a license? Are you doing it only for a few? Or is it because this is in the larger interests of the country over the longer term?
No, sorry to have interrupted. So you don't buy the argument that this is at some level frustration with the inability to expand banking capacity in the country. Realistically, Dr. Rajan, we've had on-tap licensing for a while. There's been one application, which is from Navi. So there does seem to be a lack of interest in the existing stakeholders to come into banking.
Yeah, but I would argue that if you look at credit growth, it's fallen tremendously amongst the public sector banks. So if you want to fix that, why not look at your public sector banks and ask what's gone wrong? What is it that can be remedied here in order to increase credit growth? Why do you have to bring a whole new set of banks in, in order to get that credit growth? In fact, most recently, even the private sector banks have slowed credit growth. So it's not, the problem sometimes lies in thinking there are shortcuts to the longer run issue of how do I improve credit growth? How do I improve credit information? How do I improve credit recovery, right? We had this reform of the IBC. Now the IBC is suspended. And even while it was working, it was slowly increasing the delays in recovering the money. So I mean, think about the framework and start fixing the framework. That's tough. That requires more work. It's not a shortcut. But shortcuts could get you into even bigger problems than you are in today. It is true, India's credit to GDP is very low, but India's NPA to credit is very high. How, with such low credit to GDP, do you have such high NPAs, right? Ask that question before you ask a conflicted set of bank owners to come in and possibly add to the load of NPAs. So I would say shortcuts are the bane of our system. Let's take the long path to figure out what's going wrong and fix it. And that requires hard work. That work can be done. We've done it before. We need to do it now.
One theory to the why now, and you allude to this in your note as well, is that the government wants to privatize PSU banks. It's not clear who are these investors who would come in and buy even minority stakes, leave alone majority stakes. But again, as you point out, handing them over to corporates is perhaps the last of the options you should look at. And an old banker, D.N. Ghosh, had pointed out that we have seen this play out in the pre-independence days. We had industrialists own banks, and it left us in a very bad position. So there is precedent for saying that that's not the route to go down.
Yeah, I mean, the whole point of nationalization was in some sense to expand the access to credit. We can debate till the cows come home whether that was successful or not. But we do have to ask, was that a fantastic system beforehand? And of course, in the pre-independence days, when you had management houses and so on, we had fairly closed networks within which credit sort of circulated, and that didn't do wonders for everybody else. But I am willing to believe there are some corporates who are going to be the next Ant Financial, okay, and create a tremendous amount of new lending, etc. But that's when we also have to ask, are these the same corporates who are huge in the country already? And can we afford the kind of concentration of economic and political power that means? And I mean, I think that we need to ask all these questions before we say this is the one answer. If we want to do, again, a good job on privatizing the public sector firms, Viral and I wrote a piece on this, but our point is really you have to improve governance. Yeah. There is no shortcut to that. We know you can't just throw them into the public and expect governance to improve, but you can't also give it to somebody else and say, now we're giving you a full-fledged bank with all the access to funds and, fix it. Because it could be fixed in very bad ways, especially if you have a conflicted owner. Yeah. Give it to somebody who already has huge debts. And, they will find a way to make those debts paid down or borrow from the banks to pay down those debts and even expand. So our controls on some of these large industrial houses and what they do is limited. And in that scenario, this is playing with fire.
Just a couple more questions, Dr. Rajan. So one on governance. It was pointed out by someone in the financial sector that the governance problems are ownership agnostic, which admittedly has been true. We've seen governance problems in PSU banks. We've seen government problems as governance in private banks, diversified private banks, promoter-held private banks. But surely that's a perverse reason to say that, okay, if there are governance problems everywhere, let's just open it up to even starker sort of areas of governance issues.
Well, I think you have to be careful. The size of the governance problems in some of the old private banks, which are very narrowly focused in terms of the holdings and often are focused on specific communities, there's a long history of those governance problems. Some of them have made the transition into much more modern banks and have done very well. Banks like Federal Bank and so on. So I think it is possible to transform them, but they're really quite small and therefore not a really not a huge issue. And over time, they have been ownership has changed, and some of them have improved. On the large private banks, especially the widely held private banks, yes, there have been some very well publicized incidents of misgovernance in a couple of them. But if you look at the size of the NPAs, the size of the problems in those banks, they are relatively limited compared to the size of the problems of the public sector banks. So I think in terms of magnitude of the mislending or the poor lending, the public sector banks are much higher. And it's not just the infrastructure. Now, if you look at the small and medium sector lending, that's where a lot of problems are starting to emerge. And the size of the NPAs in that lending, even though it's quite recent, the size, when you make recent loans, it takes time for them to go bad. Yes. Now, the size of the NPAs in MSME lending is increasing significantly in public sector banks. So I would say the number one governance problem is in the public sector banks. Clearly, we have to improve governance across the board, but I think it would be wrong to characterize the size of the governance problems in the private banks as equivalent to the size of the problems in the public sector banks.
Sir, one issue, of course, is the direct licenses to industrial houses. The second is sort of a backdoor entry, which again you speak of in your note. One is via payment bank conversions, and the second is via conversions of NBFCs, which belong to large corporate houses. While the working group has given a list of to-dos before such an activity is permitted, they don't make it contingent upon actually the Banking Regulation Act, for instance, being amended. Both those, do you think, are risks to backdoor entry of corporates into banking?
When we thought of the payment bank license, it was meant as a way to get payments and inclusion done by potentially industrial houses, including some of these telecom houses, but with no access to credit. Everything that they collected had to be put either in deposits at the scheduled banks or in government securities. So that was a way of ensuring they would be safe and they would focus on payments. If they wanted to make loans, they could tie up with a bank. And actually, some of them applied for a license jointly with banks. I haven't kept track of how that is progressing. So that was the idea behind payment banks. Now, sometime later, in 2018 or 19, they said, okay, payment banks, after 5 years, we will consider you for a banking license. However, I think that meant only payment banks that were run by financial companies. And the idea was, okay, we've seen how you handle money. We have more confidence. Now we think you can possibly start lending. Both payment banks and small finance banks were thought of as proving grounds for entities to sort of learn the business of banking, to show they were good. And after they showed they were good, they could migrate to a banking license if they were thought fit and proper at that time. Okay. So all this was only for companies run by financial sector companies, not by industrial houses. The assumption that industrial houses are now eligible if they hold a payment bank license, I think is wrong. They would still be prohibited if they're industrial houses from migrating from a payment bank to a full-fledged universal bank or a small finance bank. However, with this amendment, if it is approved by the RBI, then there would be nothing standing in the way of getting a payment bank license, spending 5 years, then applying for a universal bank license. Actually, 3 years now, which is what has been brought down. The other side, NBFC's conversion, same problem. Again, if the NBFC, the whole sort of advantage of banks comes from offering deposits, because the public thinks deposits are safe, no matter who offers them. Finance companies, NBFCs can't offer deposits, not the short-term deposits that the banks can. And so they are distinguished from the banks. So still industrial houses can operate finance NBFCs. But when it comes to deposit taking, it seems that we should put that barrier, because otherwise it becomes too easy to raise the money, and then you become too big to fail in the eyes of the country. Very few large banks have been allowed to fail, and that allows you essentially to own a printing press, a money printing machine, and entrusting industrial houses with that would be problematic for the most part.
Dr. Rajan, I'd be amiss if I didn't ask or put this entire debate in the context of the existing supervisory and enforcement capacity of the Reserve Bank of India. Even if hypothetically the principal debate moves in one direction of permitting corporates or corporates with other non-finance business into finance. Would you say that it's absolutely important for the RBI to strengthen its supervisory and enforcement capability even before you move in that direction hypothetically? Because we've just seen so many financial sector accidents.
Yeah, no, I that's precisely why Viral and I asked why now.
Yes.
We just had a few accidents. Shouldn't we focus on learning the lessons from that? For ILFS, what is it that we're missing on large NBFCs? How do we improve the whole process? I mean, to my mind, there's blame enough to spread on ILFS, including who the directors were, who the auditors were, and of course who the regulators and what the regulators and supervisors were doing in sort of monitoring the progress of ILFS. But I would say that Yes Bank is another issue. I mean, we have for some time been looking very closely at Yes Bank and trying to understand what it is that they were doing to show such profits while showing such low losses. And over time, we understood what they were doing and started bringing them to book. But of course, it has come at some cost. And so we need to understand this. We have some processes in place in trying to improve the flow of information, automating some of the data transfers from the banks to the RBI, but also trying to understand better what it implies. So I would say, let's get all that straightened out. Let's make compliance much more effective for the existing banks. And maybe at some point, we will be able to deal with conflicted banks that start with a huge conflict of interest, but because of very stringent regulation and supervision, don't succumb to that. We are not there yet. And so to do this now, it seems to me, would be really to invite trouble. Why not fix the problems in the system already, rather than invent new problems?
Sure. My last question, Dr. Rajan, is on process. In your note, you flagged off the fact that most of the independent experts that the committee spoke to had said that they're not in favor, only one had. I want to bring in another aspect. If you look at the composition of the committee, two of the members of the committee are actually central board members, with two members from the RBI internal staff. Does this suggest to us that the central board's influence on matters of RBI regulation, which was very much an internal issue, and the central board perhaps stamped it off, but may not have had direct influence on it, is changing a little bit? I mean, previous committees have been PJ Nayak-led committees, Bimal Jalan-led committees. Why is a central board-led committee making a call on this?
I don't know. I don't want to speculate. I don't know why this committee had the particular structure it had.
Broadly, though, Dr. Rajan, last word, you would advise that we just put this on the back burner, fix all the problems, and some of the technical recommendations, as even you say, are very doable, and some of them make sense. Yeah. Let's do those. The
holding company. Yeah, if you're only a finance company, you don't need that holding company structure. I mean, you don't need a holding company on top of one bank. There are some of those rationalizations that make absolute sense. I guess the promoter holding, we've gone back and forth. Should it be 15% or 26% at the end? I know some people want it to be 26%. You could have a long debate about that, and there have been long debates. So I think the main sort of issue is really this one, and I would I would ask the question precisely, why now?
All right, I'll leave it at that, Dr. Rajan. Thank you so much for spending time with us. Really appreciate your time. Thanks.
Thank you. You're most welcome.
Thanks for watching Bloomberg.